Today, we're going to pull back the curtain on one of the most powerful, but maybe least understood institutions on the entire planet, the Federal Reserve. You know, it's kind of like the silent manager of the U.S. economy, and believe me, its decisions affect everything from the loan on your car to your job prospects. So let's dive in and see how this whole thing really works.
Okay, so picture this. The economy is in a complete freefall. Think back to the Great Recession or the chaos at the start of the pandemic. The Fed's #1 go-to tool to fight this is to slash interest rates. Why? Because it makes it cheaper to borrow money, and that gets people spending again. But what happens when interest rates are already at zero? What do you do then? Your main tool is basically broken.
And look, this is not just some academic theory. Check out this timeline. Back in 2007, the Fed had tons of room to cut rates. They were up over 5%. Fast forward to 2009, and bam, they've hit rock bottom. Then it happens all over again in March 2020. They're right back at what economists call the zero lower bound, with absolutely no room left to maneuver.
So that brings us to a huge question for the economy. When your primary weapon against a recession is completely out of ammo, how do you even begin to fight back? Well, to get that answer, we've got to understand the institution that's in charge.
And this is where the Federal Reserve, or as pretty much everyone calls it, the Fed, steps onto the stage. It's the central bank of the United States, and its whole job is to keep our massive economic engine running smoothly, whether times are good or really bad.
So what in the world is a central bank? Well, at its core, it handles what's called monetary policy, which is a fancy way of saying it manages interest rates and how easy it is to get credit. But it also has this other critical job, making sure the entire financial system, the plumbing of the economy, stays stable and doesn't fall apart.
And if you want to understand just how influential the Fed is, you only have to look at its leader. The person in that top spot, the Fed chair, holds what is arguably the most direct economic power on Earth. Seriously, a single off-the-cuff remark can send global markets soaring or send them crashing down. Their words carry so much weight because they signal where the entire U.S. economy is headed.
So how does the Fed actually do its job? It's helpful to think of it like this. The Fed has two different toolkits. It's got one for normal, everyday situations, and then it's got another one that it only breaks out in a major, full-blown crisis.
The easiest way to think about standard monetary policy is like the pedals in a car. So expansionary policy, that's the gas pedal. The Fed lowers interest rates to get people borrowing and spending, which helps fight off recessions. On the other hand, contractionary policy is the brake. The Fed raises interest rates to slow down an economy that's running too hot and to fight inflation.
So in normal times, the Fed uses something called open market operations. It's basically just buying and selling short-term government bonds to gently nudge interest rates up or down. But in a crisis, when those rates are already at zero, well, that's just not going to cut it. That's when it has to turn to its emergency tool, quantitative easing, or QE for short.
So what on earth is quantitative easing? Well, instead of just buying those short-term bonds, the Fed starts buying up massive, and I mean massive, amounts of long-term bonds and other assets. This injects money directly into the financial system. That pushes down long-term interest rates and encourages lending and investment when nobody else wants to. This is the Fed's big, powerful answer to that whole zero-bound problem.
And the scale of this whole operation, it's just hard to even wrap your head around. To fight the Great Recession and then the COVID recession, the Fed's balance sheet just ballooned to over $8 trillion. That's trillions of dollars just created, essentially out of thin air, to buy up assets and keep the entire financial system from collapsing.
Okay, I know all this talk of trillions of dollars and monetary policy can feel really abstract, but the Fed's decisions don't just stay inside some building in Washington, D.C. They create this huge ripple effect that ends up right in your pocket. We're talking about your mortgage, your car loan, even your job.
So here's how it works. The Fed cuts rates. That means banks can borrow money from each other more cheaply. And what do? They pass those savings on to you. You see lower interest rates on mortgages, car loans, and credit cards. All of a sudden, it's way more attractive for you and for businesses to borrow and spend, and that gives the whole economy a jolt.
But look, if it were that easy, we'd never have recessions, right? The truth is, the Fed is locked in this constant high-stakes balancing act, and there are some major hurdles that make its job incredibly difficult.
Yeah, this is not an exact science at all. First off, you've got time lags. The Fed makes a move today, but it could take 1 to 3 years for the economy to fully feel it.
Then, during a recession, banks might just get scared and hoard cash as excess reserves instead of lending it out, which totally weakens the policy. The Fed also has to watch out for asset bubbles. If you keep rates too low for too long, you could inflate stock or housing prices to really dangerous levels. And on top of all that, there's the constant risk of just flat-out overreacting. If you go too far fighting a recession, you might spark runaway inflation, but if you go too far fighting inflation, you could cause a brand new recession. It's a tightrope walk.
There's a really great analogy for this problem. It's the idea of pushing on a string. Think about it. When the Fed wants to slow the economy down, that's like pulling on a string. It's super effective. But when it wants to speed the economy up, that's like pushing on a string. The string just kind of folds up, right? Because you can't force nervous banks to lend money, and you can't force nervous people to go out and borrow it.
And this all leads us to a really fundamental question. The Fed has this immense, almost unbelievable power to shape our economic lives, to literally create trillions of dollars and steer the course of the global economy. But its leaders, they're appointed, not elected. So that leaves us with this crucial debate. In a world this complex, should such a small, unelected group of people hold this much power over all of us? It's definitely a question worth thinking about.